Hello, Dan Passarelli here. Happy Friday. I hope you're feeling great today and ready for the weekend to get some relaxation and time to do some market research. And you'll have an opportunity to do that. And here are some things that you might want to think about. First of all, today, PPI came in kind of a lot lower than expected, which would typically be good news and lead the market to think towards lower interest rates. But literally, Fed speakers have come out and said we're going to have to wait to see what happens with tariffs before making any changes to the interest rate. So probably not lower interest rates anytime soon, priced in an 80% chance of staying the same. So what do we have on tap for next week then? Next week, we have pretty much no news. There's really no major volatility event scheduled except for earnings is kind of whimpering in next week. It's not going to be the biggest week for earnings. The biggest week for earnings is going to be the week after. But by the way, I will be having a live training on how I'm going to be looking at earnings this earnings season, because holy cow, it is going to be very, very interesting trading earnings this season. And I want to share with you how I'm going to be looking at that. Just go to markettaker.com/REG and get registered for next week's online training. Now, all that being said, what will we be looking at next week? Well, we'll be starting the week already pretty high volatility. The VIX at 37.56 as of the close. That's pretty high level, and we've been there for well over a week. So we'll be starting the week with that. But while we don't have a lot of news next week, we do have something kind of special. That is, it's a short week. We're closed Friday for the Good Friday holiday. And you know what that means? That means there's an extra free day of Theta that comes in. That also means that the market is going to start taking the weekend out a little bit earlier. So with this really high volatility that's going to collapse at a much faster rate, there is an opportunity for volatility sellers that have nerves of steel. Because when we sell volatility, we're usually playing a game where the underlying can't cross a certain level. Now, I'm just looking at SPY here, but we could say the same thing for a lot of stocks. Where do we really want to draw that line in the sand? If I'm going to sell a put credit spread or a call credit spread, where am I setting those strikes? I think it's pretty unlikely that next week we make new lows unless there's some big announcement on tariffs, which there absolutely can be. I think at this point, it's probably more likely that any news, it's more likely that it leads to an upside move than a downside move, but I'm sure not ruling a downside move out by any stretch of the imagination. I just feel like China's made their case already. They said that they're not listening to Trump anymore. They're leaving their tariffs what they are, and that's that. So anything that could come out of anything with China would be a negotiation that either doesn't go anywhere, which it's already nowhere, or does go somewhere, which would be a positive. I mean, there's a lot of moving parts, but I think that's kind of true across the board. So I would put more risk, if you will, or the possibility of a big move more likely to the upside. So selling things like put credit spreads for the not faint of heart, but people who do have nerves of steel, there's a pretty good chance that if a trader sells credit spreads that expired, not this next week, but the week after, that you could fetch a pretty decent premium that collapses pretty quick as well. You know, we have two inside days. We did break out over this inside day today, which, you know, I did mention is kind of potentially somewhat of a bullish signal. Fundamentals are really driving the market. We can't focus too much on the technicals, but it is a somewhat bullish technical signal here. One of the most crazy volatility things that we saw this week was bonds. I had dinner with a good friend of mine an old friend of mine who trades bonds, who pointed out that 2 days ago there was a 10 standard deviation move in the bonds. And the day before that, there was also a 10 standard deviation move. That's basically impossible to happen, but it did. That's just massive, massive volatility. And that has a lot to do with policy changes going from, no, we're definitely not going to change our mind, to, oh, well, we changed our mind, which is maybe a little bit discrediting to our bondholders. Because of that, that drives interest rates higher. And we've always had this thing called flight to quality, where when there were disasters, the whole world would go to U.S. treasuries because they were considered to be the safest asset. We may have lost a little bit of credibility with that at this point, which I think is one of the reasons why we have seen gold just massively, massively shoot up over the past 3 days. So gold is another one of those things to keep an eye on, as well as treasuries. Brain dump for you. There's a lot of things to think about this weekend. If you have any thoughts or comments, feel free to send me an email or post a comment underneath this video. Have a great weekend. Trade smart.